Wealthies, welcome back. If you're new here, this is All the Wealth, WealthMore's wealth building channel. I'm Mical Jeanlys-White, the founder and CEO. And with me today is Matt, our CFA and portfolio strategist. We are so excited to be back from a well needed break and back with a look at what has happened in the markets in 2025 and what lies ahead. And what a day to be back, Matt.
It's never a dull moment out there. So excited to be back and chat about what's happened and what's currently happening today too.
Yes, we prepped for this, and we also knew that today the Fed chair, Jerome Powell, would be talking from Jackson Hole. And boy, he did not disappoint. The markets approve of the message, huh?
Yeah, well, that's exactly why we're chatting right now. We just knew that the markets would be up 2% or like 850 points on the Dow. It was just all planned, but on our part for sure.
Yeah, like we have a
Yeah.
magic ball, don't we?
I think so. I think so. Yeah, he basically said what everyone thought he was going to be saying. We're looking at September, their next big meeting, where he's kind of expecting to start lowering interest rates. So the Fed's going to start to get dovish and support the system again. And stock markets love liquidity and love lower
Yes.
rates.
Yes. And you as consumers should also like lower rates. Prices have been running hot, inflation, everyday things. We're seeing it everywhere. A lot of retailers reported earlier this week, and they were seeing a lot of softness in sales because when things prices go up, people don't have as much money to spend. So rates coming down is good news for the consumer. Home buyers,
Yeah,
good news for homeowners. I just saw a report where July was the highest month of people pulling out of their offers to buy a home.
Yeah, and it's interesting because the average price of a home actually hit a new high back in July, 135,000 on
Yeah.
average across the country. But then you look at the 30-year mortgage rate that they're paying, and it's something just under 7%, I think it
Yeah.
was, like 6.7. So you do the math on that, and anyone who's had to refinance this year, I'm sure, is not as happy as they were 5 years ago.
Not as happy at all. And for those who are in those lower rates, they're not moving. Why would you?
Yeah, for
Why would
sure.
you?
And well, it's just less money in your pocket, right? And
Yeah.
that brings it back to this economic thing we're looking at where consumers just have less money in their pockets to spend on things like to buy things from Walmart and the Targets and the big
Yeah.
names that we saw report earnings this week.
But I'm so excited to be back and for us to take a step back. Here we are at the end of August. We'll have about 4 months left to the year. A lot has happened. Today was certainly the news that the market wanted to hear. And Jerome Powell did not disappoint. Obviously, he did not explicitly state that a rate cut is coming, but just the hint of it was enough for the markets to rally. The markets are dancing today.
He has been avoiding the words that he was using today. He's been avoiding being what we call dovish, which is saying that he's going to potentially lower interest rates or use his Fed speak like he likes to. But today was really, people are taking what he's saying as likely to cut in September. So that's
Yeah.
why we're seeing the markets move the way they are.
You got it. And, we will remind folks the job of the Fed is to handle two big things, inflation and unemployment. And certainly prices have been high and unemployment has been creeping up. So we saw that with the jobs market report and then sort of like the, I guess, reinstatement of that information showing that, maybe the job market wasn't as strong. And so certainly a rate cut is designed to help on both of those fronts.
Yeah, the jobs reports we saw that got politicized for whatever reason, they got adjusted pretty harshly down, like in terms of the number of jobs that came in throughout the last few months. And inflation has been, prices are still high. I think
Yeah.
the reality is that prices are still much higher than they were 5 years ago, but the rate of change is slower. And that's really what the Fed is trying to control. And as we see the rate of change go down, that gives the Fed some room to lower rates a little bit. So if you've got the employment situation that we just talked about looking a little worse, inflation looking a little bit better, that gives you some room to kind of lower those interest rates and maybe boost the economy a little bit.
Yeah, so this is a good Friday, folks. Good Friday for the
Yeah,
markets, Friday for
gonna be a good
consumers.
weekend.
It'll be a good weekend. If you had bought the dip last week, you're very happy. I always like a good dip. I always feel like this is
Yeah.
a I can't I have to admit, I don't know how to resist a dip. I like a good dip.
Yeah, it's tough. Tough. I like one myself too.
Yeah. Yeah.
If you got some extra cash coming around, you see the market's down a lot, it's like, well, is the market gonna be higher 20 years from now? Probably. All right. Yeah, it's time.
Yeah, I'm gonna be working for a minute, so,
Yeah.
it's the way I look at it. So when I tune in and I see, all of the commentators are looking dark and glum, I it brings a smile to my face. I say, "Oh,
Yeah, for sure.
what have we here today?"
Yeah. Shopping. Shopping on sale
It's
is
a
always better than
shopping day
shopping
for
at high
me,
price. Yeah.
like clearance, hitting the clearance section and, picking up some good investment opportunities there.
It's the only thing that you buy that feels worse when you buy it on sale, but it's actually the best time to buy it.
Really, it really is. So, Matt, as you look at 2025, how would you describe this year? I'd love to hear from you and for you to share with Wealthy. What's your hot take on this year?
I wish I could not be cliche about this, but this year's just I hate to say it because I hate it when I hear people say it, but it's been a roller coaster. It really has. We came into the year slowly, kind of gaining, increasing, just like a roller coaster kind of goes up slow for that first little jump. And then in April, everything went down very fast. Everyone got all sorts of excitement throughout the markets. But since that April low, things have just been steadily climbing again. So it's just goes to show that the cost of admission, the cost of those longer term returns doing well is volatility. You kind of have to stomach it every year, and this year's been no different.
Yeah. And because this year had the unprecedented tariffs, like literally hitting just about every trade partner, that is a pretty historic event, which is not likely to be a rinse and repeat going into next year. Knock on wood.
Yeah,
Right?
knock on wood.
Right?
There's
Knock
always
on wood.
something,
You never know. Don't speak too fast now.
It's it's interesting because it's a real reset in the global trade system. It's not we're not going back at this point to what it used to be. These higher rates are probably going to be in place for quite a long time. But that being said, once we get all these deals figured out and everything a little more stable, more predictable, stock markets still like predictability. So even if it's a little bit worse off, at least it's not as bad as it might have
Yeah.
been, if that makes
Yeah.
sense.
And for me, Matt, as I looked at sort of, the global impacts and what this would mean for consumers and inflation, that for me was why I personally was like a rate cut would be helpful. Because if
Yeah.
we don't, and I believe this is what maybe the second week of like the tariffs going into effect for many countries. So you look at that and you're like, this would be helpful because
Yeah.
we don't want all of the increases being directly passed on to consumers.
Yeah, not only that, but people just need a little bit more money in their pockets right now. So
Yeah.
something to help out on that side would be hugely beneficial and a good time. So
Yeah, you got it. And when people don't have as much money to cover their day-to-day expenses, they have less money to save, they have less money to invest, which makes their, financial outcomes less upside to it. And that's
for sure.
definitely what we do not want.
Yeah. Yeah.
So here we
Totally
are.
agree.
I kind of feel like we're at a good place on this roller coaster. So when we look back, I'm all about returns, right? And everyone's here looking for better returns, ways to put their money to work. How have the markets done? Like here we are, end of August. How have all these indices actually done?
It's been pretty good. Obviously, despite that dip, if we look at the major indices, the S&P 500's up about 8% this year. The tech-heavy Nasdaq has done the best. It's up almost 10% this year. I'm not including the boost we've got today, so we're probably a little bit higher than those
Higher.
numbers. The Dow Jones, which is about 30 large cap kind of old economy stocks is up about 5.5% this year. The fixed income side, we look at like long-term treasuries. This one's a little more interesting. It might be a little more surprising. It's up only, it's supposed to be more conservative. It's up about 2% on the year. But in the last 12 months, it's actually down quite significantly. Those longer term treasuries, they're down about 9%. So that could affect a lot of those balance type portfolios or fixed income type portfolios if they have what's called too long of a duration. So too long on their fixed income holdings.
Yeah.
Last few, we've got like cash. Cash has actually been good this year. If you're investing in high yield savings account, you're getting like 3, 4, 5%, depending on your lock-in period. We talked a little bit about real estate this year. Prices are good. Mortgage rates are quite high. So we'll see if that ends up changing the
Yeah.
trajectory at all. And then finally, the alternative assets have done extremely well this year. Bitcoin's up 20% plus, Ethereum's up 30% plus,
Yeah.
and gold as well. Gold's right up there, 25% plus this year. I mean, the takeaway stocks are positive, bonds are a bit sluggish, cash is finally useful again, and alternatives have really been a star performer this year.
Yeah, I definitely want to double click on the bonds because we know the bond market was really looking for this rate cut. They were desperately looking
Yeah,
for
for
this
sure.
rate cut. Yeah, they needed that.
In the last year, the last couple of years, it's all been about rate hikes. And
Yeah,
and for people listening, bond prices are negatively related to interest rates. So as interest rates go up, bond prices go down. So, we had a couple of years there where bonds just couldn't find any sort of gains because their interest rates are so small to begin with. You buy a corporate bond that's giving you 5%, and then interest rates end up going up 3%, you lose a lot of that
yeah,
leeway that you had. So bonds have been really trying to get this interest rate cut from the
yeah,
Fed to help boost their prices.
yeah. But I wanted us to talk about like each of these asset classes and how they're doing quite intentionally because the reality is putting your money to work, even in a roller coaster market, serves you well. Across the board, we heard things are up, even in a year that's been very much a roller coaster. Be it the S&P at 8%, the Nasdaq at 10, and who knows where things will settle out today and with sort of even more positive news in the markets, even cash giving you a nice return, treasury bonds. I won't go into the alternatives because I have points of view about that, but
Hmm.
things that we can track returns, things that we can track sort of like their underlying performance have done quite well. Even real estate, maybe if you're trying to get into the market, feels like it's a high sort of barrier with the rates. But if you're a homeowner, you're seeing a nice appreciation on your real estate as well.
Yeah, it's really been an we call it like an everything rally this year. It's hard to find asset classes that if you've invested and stayed invested, hard to find asset classes that have really done poorly. There are sectors and certain ones out there, but yeah, in general, it's been a good year to be an
Yeah.
investor for sure.
Yeah. And I say this because as we've talked to wealthies, particularly as the market was getting rocky, there was concern around, hey, should I pull my money out? There were some people, some of our members who were very concerned. But I think a lot of what we talk about on this podcast really help people get a little more perspective, like sharing what's happening, the returns that we're seeing, so that we can create transparency for you guys, so that you can sort of see across these different options that you have, how they're impacted, how they're performing, and how it still serves you well to put your money to work.
Yeah. And we talked a little bit about a couple of times now about proper diversification as well. That point is only getting more accentuated in the last sort of 6 months. We talked about how the old adage of you just buy the S&P 500 and wait, that's getting a little bit risky to do that nowadays. Those tech companies make up such a large percentage that we got to make sure that we're investing and diversifying properly. So,
Yeah. Spot on,
yeah.
which is a nice segue into my favorite investments, our WealthMore portfolios. So, Matt, how are we doing with our four different WealthMore portfolios?
Yeah, we're really pleased with how things have gone so far this year. We run 4 core portfolios. Each have a different risk profile. We've got the aggressive portfolio, just for our most risk taker type clients. We've got our moderate portfolio, which is next on the risk profile. Balanced, again, a little bit less risky, and conservative is for those who, they want to sleep well at night. They don't want to take on much risk at all. So, and when I say risk, I really mean like stock market, buying equities, things like
Yeah.
that. Our aggressive portfolio in the last year, to the end of July, it's up about 11%, which we're pretty happy with. Yeah, it's a good. We've had exposure to not emerging markets, but international markets and domestic. We're concentrated in good sectors. We're happy with that for sure.
Yeah. Yeah. I'm in
Um,
that one and I am always pleased when I log in.
Yeah, yeah, it makes you feel good for sure.
Yes.
Next is our moderate portfolio is the next one. It's actually a mixed portfolio as well. It's got about a good chunk in fixed income, about 20-25%. It's still up about 9% in the last year, so really happy with the way that one's turned out. The next two, again, we're moving down on that
Yeah.
risk level. The balanced portfolio is about half, 50% fixed income. That one's even up over 8% in the last year. So we're really pleased with how these things are going. And then finally, our conservative portfolio. This is our sleep at night, want to invest, should invest, but got to make sure that you don't. The goal is to try and not lose money more than make a lot of money. It's up about 4% in the last year.
Yeah.
So pretty solid across the board.
I love to hear that. This is something for those of you who are WealthMore members. We send out our monthly newsletter. We cover one of the portfolios in each of the newsletters. And of course, you can also meet with your wealth advisor at any time to discuss the investments and how we approach it. But we are very deliberate about making sure these portfolios are well diversified, that we are monitoring market activities and making sure, the low cost ETFs that are in there are designed to help our members see that much more upside.
Yeah, for sure. But we're not trying to pick the hottest stock or over allocate. We really just want to have the proper exposure, properly diversified, and set it up so that it's in line with what investors want to
So, Matt, here we are. It's close to September. What do you see happening with these asset categories as we approach the last 4 months of the year?
I sort of see three big things that are kind of driving markets. We've talked about them a little bit already. Tariffs and trade policies are going to be front of mind. Every deadline, every deal, or every reversal tends to kind of move markets one way or another. Another one throughout the rest of the year, we'll be looking at tech earnings, technology companies. So AI leaders like NVIDIA, they're going to continue to kind of set the tone for where markets are going to be. And the third, like we're seeing today, interest rate expectations. So what the Fed's going to do, what the market's going to bet. If the Fed surprises by cutting more than maybe people are expecting, that could boost the markets. So I think those are going to be the main three we look at throughout the last few months of the year here.
Awesome. So we wanted to reach out to our wealthies and bring in some of the things that are top of mind for them. And so we thought we would introduce a new little format here where we are bringing questions that wealthies are asking their wealth advisors, things that we know are top of mind. And oh boy, today was a great day because hey, we just had the Fed. So some of this we may have already answered. But one of the big questions was, when are prices of everyday items expected to go down?
Yeah, it's a bit of a problem these days. People are, everyone's affected by, if the price of eggs goes up 4 times, you're not going to want to buy eggs. But, unfortunately, it's hard to say if these prices will come down on an absolute basis. What we really concentrate on is that cooling of the rate of inflation. That's really what the Fed's looking at. If you want to see lower prices, you ought to have one of two big things happen. Either you have a real economic downturn. So I actually think lower prices will be the least of your concern if
Yeah.
that happens. Or two, we see some sort of innovation that can bring prices down by making companies more efficient. This one's more likely. We're already seeing it with gains in technology. So things like AI making companies more efficient. Companies are more efficient, they can afford to either slow or decrease prices to bring more demand because they can kind of meet that demand. If you look at things like what a TV cost 15 years ago. You're going to be spending an arm and a leg trying to buy a 65-inch HD TV. Nowadays, $500, you can get a nice one. There's certain areas where it's going to be hard to say if the prices will come down, but in other areas, maybe we can see more efficiency-driven price reductions.
And maybe it's important for us to set expectations for folks because if you're out there expecting inflation to get to 2% by the end of the year, not likely to happen. So even if
Yeah.
we get like a 50 bips or 100 bips rate cut, and we're not likely to get 100, guys, I shouldn't even say that out loud, but you're not going to see
You
a
heard it here first.
can say that one with confidence. You're not, guys, going we want prices to come down, but prices are not going to revert to maybe what you saw 3 years ago. We certainly
Yeah.
want them to come down, but we should be realistic about, what the everyday consumer can expect. So as you're thinking about your day-to-day budgets and things that you need to make adjustments on, that would be sort of the way to think about it. We want them to come down, but they're not likely to come down to where they were when inflation was running at more like 2 and a quarter.
Yeah, and there's ways you can control that on your own, like everyone can. There's ways to save money on certain things. If you're spending, $50 a week on coffee, maybe you try and cut that to 25 instead. So little things like that can add up and help you with those price increases.
Yeah.
As much as, everyone likes to have their Starbucks coffee every morning, maybe that's not the best thing to do right now.
Exactly. Exactly.
Yeah.
Or maybe not every day.
Yeah.
You switch it up a bit.
Yeah.
2 out of 5.
Yeah. You can make really nice French press at home. I can confirm.
There are ways, guys, so we don't want you to
Yeah.
feel like there are absolutely no ways, but it's all about being realistic, dealing with your economic situation as it is in the moment versus where you may wish that it were. The other thing that wealthies wanted to know is, will the rate cuts be enough? Prices are going to be higher with tariffs. Will these rate cuts offset higher prices that may come with tariffs?
It's going to depend on your individual situation for sure. So say you have a big mortgage renewal that you need to do, a rate cut will really help you save a lot of money. Or if you have lots of interest, like floating interest rate debt, that's going to help you a lot more. But if someone doesn't have that type of debt, then maybe an interest rate cut will actually be net negative for them because interest rate cuts in general actually are inflationary by nature as it works with the economic system. If we give people more money, they're going to spend more, which means more demand, which drives up prices. So that's the needle the Fed's kind of trying to thread right now is how do we lower rates without increasing inflation too much? So yeah, it'll depend on your situation for sure.
Yeah. This one's one of my favorite ones of the questions. Now that we have tariffs in place, what does this mean for returns on investment in the stock market?
If I knew exactly what the
That's why it's
answer to
my
that would
favorite.
be, I would love to, I'd be sitting on a beach in my mansion, maybe, hanging out. In reality, we just don't know. We have to wait and see. First of all, we don't even know what the final tariff rates for every country or every place is going to end up being. And even with that, we don't know what the knock-on effects are going to be.
Yeah.
So who pays the increase in tariffs? Is it going to be the end consumer, which is kind of the expectation, or are the companies going to eat some of that costs? Are the exporters from the other countries going to eat some of those costs? There's so many
Yeah.
variables that go in with these types of things that we just don't know what the effect of that will be on anything, let alone the
Yeah.
stock market.
You
And
got it.
the stock market tends to really run by its own tune as well. The stock market's based on expectations, and sometimes it's not even bad news that will drive a market down. Sometimes it's just less bad news that will help push a market
Yeah.
higher. If people are expecting something really bad and it's not that bad, markets can
Yeah.
rally. people are expecting good news and it's really good, markets can rally. If people are expecting really good news and it's sort of good, markets might fall. So, it's
Yeah.
whether we can say what the tariffs will have an effect on the stock market. I wish I could give you a good answer on that one. I'm doing my best to give you the right answer.
Yeah, yeah. And it will also depend on certain sectors, right? Like how heavy is a sector dependent on imports? And then, frankly, the leadership of different organizations, like how smart are they at managing the cost increase? Where can they find other opportunities in their organizations to reduce costs to offset things? Like this is where, smart leadership, good leaders at different firms makes a big difference. How they're even scenario planning is also a big, big impact versus, I would say lazy leadership is to just pass it to the end consumer. And because I'm
For
also an end
sure.
consumer and I don't like that.
And as an end consumer, if you start to see prices going too high, what did we just talk about? We
Yeah.
talked about changing your behavior.
Yeah.
Again, that of if the price of your coffee is getting too expensive, you're going to start making coffee at home, even though you don't want to, or you want to have that luxury. At the end of the day, it's a luxury. So if it's too expensive, you can change your behavior. Good corporate managers, they understand
I
that and
understand
they'll
that.
they'll
Yeah.
adjust for sure.
Yeah.
As
This is,
investors as well, we have to take a longer look at things too.
you got it.
We're not investing for the next 6 months or 2 years. We're investing for the next 10, 15, 20 years.
Yeah. And having been at this for quite some time, we certainly have our points of views on which corporate leaders are better managers versus others. There's certainly ones that we'll be keeping our eyes like closely in terms of like how they manage this. And it'll show up in products that we see in their stores. It'll show up in how they're approaching pricing, other news around how they incorporate innovation to bring costs down. So it'll be, I'm excited for 2026 to see.
Yeah.
Yeah, I'll have my
It
eyes
w
nicely.
it won't be boring. I can guarantee you
It
that
won't be
much.
boring. It won't be boring.
No,
I'm looking forward to it because I think these events are where we really see where the strength in leadership resides in different organizations.
for sure.
And then this one we have, are there any parts of the big beautiful bill that investors should pay close attention to?
Yeah, the investors should really watch the provisions around kind of permanent business expensing. That's probably going to boost corporate investment, which can support stock market growth, especially lower taxation levels, things like that. But on the flip side, it's also going to add to the deficits. The expectations are that it's going to add $3.4 trillion dollars over the next 10 years to the deficit, over 4 trillion if you account for some of the interest costs. And that to not to
Okay.
go back to another a word we've been using a lot, but that's inflationary, right?
Yeah,
To have that interest rate, so or that debt and
yeah,
interest rates as well. So yeah, we'll see. I think net
yeah.
positive for stock markets because it's net positive for companies.
Please.
And in general, stock market returns tend to correlate with earnings, and that's the best barometer we have for if a stock's going to do well or not.
You got it. And if we are doing better, then hopefully that impact to the deficit won't be as great. If people are making more money, they pay more taxes, your deficit, you can offset it. So fingers crossed on that, but certainly a big, big watch out on that. Yeah.
Well, if we
Big
have
watch out.
100 basis point drop in the interest rate, then that'll help as well.
That, yeah, that certainly will. But that's not happening. We want to make clear that we don't expect that to happen. But if it does, oh boy, are we clairvoyant. So, lastly, let's wrap up with here we are. We have 4 more months to go. What are the top 3 things that wealthies should be looking to do as we look to close out the year, which is kind of like staggering to say that we're already talking about closing out the year?
I know it's like almost like September in a week and a half, something like
Yeah.
that. It's been going crazy fast.
My brain
I,
is still
if
on
I
my brain is still on Liberation Day at times.
Yeah, that was all the way back in April. That's a full year away at this point. If I had to say 3 things to kind of focus on, you look at maybe review your allocation. We've had a really good stock market this year, so if you might be over allocated to equities without even kind of knowing it. Talk to your advisor or wealth manager if you're over concentrated on one sector or stock. Maybe you have another portfolio, something like that, just to keep in mind. The second I'd say is automate your savings. Like there's no better way to invest long term than to make it automatic. And it adds up over time for sure. Especially if you're early on in your investing career, it's really important to put something away every month, every time you get paid. And then we just talked about a little bit too. The third one, maybe adjust your budget in ways that you can. So, and know your budget. Prices aren't going to fall back to where they were 5 years ago. So you got to plan realistically and keep, keep your investing on track that way too.
Yeah, I love that. I love the points on that budget. I think most of us don't like to go revisit the budget. I think we get
Yeah.
comfortable, but this is the time to do it, especially as we're sort of approaching the back end of the year and thinking about next year. And you guys know I'm the biggest fan of auto investing. It is one of the best ways to just also benefit from average dollar costing so that you get the benefits of when there was a market dip, it would sort of automatically loop you into it. So if you're not doing that, highly, highly recommend that you do that. And now is a great time to talk to your advisor. It's a great time for a check in. We're going into the fall. Seasonal changes are always like a nice kind of like rebirth, review
Back,
time. Yeah,
back to work after the summer too. So it's a good time to
exactly.
pen to paper and figure out what you're doing.
You got it. Hopefully, you guys lived your best life during the summer.
Yeah.
Um, hopefully not overspending, but now's a great time to do that reset. Take a look at where things are, your 401k plans. If you haven't been putting money or haven't been meeting the company match, now's a great time to look at that. You can make those catch up investments now so that you can get the match if you're not, or if your goal was to max that out and you're behind, you definitely want to look at those annual limits for that. It's just a good time to do some fall housekeeping.
For sure.
Well, Matt, this was great as always. I think we hit all the major things. I'm very excited for investors, wealthies. I'm excited for you guys looking at how the market is going. To Matt's point, it's been a bit of a roller coaster. Maybe you guys had to take a little bit of like Tums to like navigate it, but we're here.
We made it. We made
We
it.
made it. It's looking positive. Investing is a long-term strategy. Let's stay on track. This was great to talk about. If you guys have questions, please schedule one-on-one with any of our wealth advisors. Community is free. You can sign up on the web. You can also download the app. But until next time, this is All the Wealth. Stay on track, wealthies. Thank you.
See
Thank
you
you,
guys
Matt.
later. Thank you. Bye bye.